Hey, welcome back. Part two of how to buy stocks safely with the key on safely. Uh, at the end of the last video, I talked about uh, nothing is lost by delaying all new buying, and preserving your money is most important before ever making money. Just a reminder, that is, if you didn't invest and you saved your money and you didn't lose it, that is your first victory and always your first guidepost. So the second quote that I wanted to say or share is from a hedge fund manager, again from the modern era today. His name is Michael Burry. You might know him, Dr. Michael Burry. He became famous with he was one of the Big Short uh, guys who saw back in the early 2000s that the real estate market was being held up with house of cards of financing and debt and debt insurance and credit default swaps, which at some point we'll get into all that cool stuff. But um, Michael said that just this week, actually, he said, sometimes the only winning move is not to play. And that echoes what I said at the end of the last video about not making any moves. Okay. Again, sometimes the only winning move is not to play. Not only is there not anything wrong with sitting on the sidelines and not doing anything because you have won, you have preserved your money, number one, but I can't tell you, I spend, let's just say 10 hours a day, because it's easily that. And I can't, I'm super lucky because I love this. I really do. But I spend 98 at least percent of my time doing nothing to do with trading, nothing to do with being on my brokerage platform and making active trades, buys and sells. That is a teeny tiny percentage of what I do. Most of the time, as they say, I sit on my hands. I'm not trading actively like that. I've done that. And I want to share that with you that years back, I would be into the micro trading. I've tried it all. And I think really, it's great to learn. And I want you to learn from everything that I did. And it's not, well, it's just there's a better way to do it. That's all I'm going to say. There's a better way to do it. And so sitting on your hands can be so challenging, just like the four guideposts of how to buy stocks safely. You analyze, you make a thesis, you look for a catalyst, and you wait for a catalyst, wait, and that's hard. And then, the discipline from there. But that waiting can be so hard. So sitting on your hands is just so challenging. And I told you about every one trade that I make. Again, you've allocated this much money to one stock. You've divided it into your four tranches, into quarters. One tranche for every one tranche of investment, I have watched 20 go sailing past. But I'm telling you, it's not about the number of swings that you take at the plate. It's about the number of base hits. Wait for that perfect pitch. As I said in the last video, there's when I've done my homework and I'm waiting and something is interesting and then it becomes super interesting and I sit on my hands and then all of a sudden I get slapped in the face. That's how I know. And that's kind of one of those feel things, but I swear if you just wait and wait, you will be rewarded. So 20 times it goes past before I ever make that buy. And along that line, regarding those buys, those tranches, I want to I want to say that if I were going back in time and starting off, a simple ratio that I would establish is to have 2 winners for every 1 loser. Okay. We'll talk about how to manage your winners and how to manage your losers as well. But for every 1 tranche, again, not the whole thing, we never invest all at once. We invest in quarters. For every tranche that loses, I want 2 tranches that win. Okay, not in the same stock, obviously, because we'll talk about that, because you don't touch a losing tranche. Just as far as a beginning strategy, I'll talk about that in just a second. So another thing that I want to say is that when you've got your trading app, you know that I like Yahoo Finance. They've got deep data sets. They've got really nice statistics and lots of user data and news feeds and all kinds of stuff. But basically, it doesn't matter if it's that or you know, uh, Robinhood, eToro, Fidelity, whatever it is. When you have on your app, please you can always touch uh, change from dollars to percentages back and forth. And it's usually right under the ticker and where it shows the green or the red for the day. And um, please switch to percentages and not dollars. And do not look at dollars. And there are 2 reasons for that. Number one, as the song goes, you never count your money when you're sitting at the table, okay? Distraction. If you're looking at something that's losing and you're looking in dollar terms, it will occupy your mind so that you can't see anything else. It does for me. Same thing if you have a winner. Okay, forget the dollars for now. You do percentages. That's the way to remain less emotional about it. But even more importantly, it's the way to compare different stocks from different sectors. Uh, it's that's the only way. One stock in one sector can have different ratios and numbers that make sense. For example, banking trades on a different uh, sort of historical average of price to earnings ratios and price to book value, and the only way that's like comparing French to German to English. You need to put them all in the same language, okay? And the percentages are that Rosetta Stone, which translates all of the languages, between each other. And I like that. I just came up with it. But anyhow, the Rosetta Stone, do it in percentages. You have to do it across the board. Leave it there. It's going to help in many ways, but that's a non-negotiable. So percentages, not price. Uh, Number 2, I said earlier, but it's worth repeating, only buy on a red day. You've done your homework. You've analyzed. You've constructed your thesis very specifically, what you're looking for, you're looking for your catalysts, you're open to seeing if other catalysts occur, but at the end of the day, you do not hit that buy button until you've got a dip. We talked all about that. And so let's talk about the 2 possibilities. Okay, you've got your full allocation to a single stock. You've divided it into the 4 tranches. Everything is right. You've done your homework. It looks great. It looks even better. And then what's next? Boom, the slap in the face. And it's a dip. And the stock pulls back. The price pulls back. You go in and you buy that stock. And there are 2 things that happen. You buy at this price and it comes back to the average, gets pulled back up and goes past where your dollar cost, your average cost is for that first tranche, and it goes up above it. That is what you want. That's your ideal situation, because then you've got that buffer. You've got that house money to play with. This is your cost. This is your profit on paper. And so this gives you flexibility. This gives you optionality with your next tranche and when you put it in. If it has lots of momentum and it is shooting quickly, then I give myself permission to move in quicker with my next three tranches to ride that momentum. But again, you want to always sort of reset. We'll talk a little more specifically about that, but that's a wonderful thing to do, to have, is that buffer, that option, those, that optionality. The second thing is it dips, you get in, and then it falls some more. Okay. I'm going to keep this simple. You are not allowed to do anything until that price that has dropped further, it dropped down and you bought it here, and then it drops further. You cannot do anything with that. You cannot put in any more money until it comes back to your entry price and moves past it. Okay. So for now, the only thing you're allowed to do, if you choose, is for the price to rise past your initial tranche. Otherwise, you keep that there. And there are two options. You can wait and hold that quarter of your overall allocation, or you can get out too. And we'll talk more about when to know when to exit a stock. But keeping it simple, that you're going to keep that 25% in there. Again, not again, but before I hit that buy button, the two things that I do, one is that price dip, but the second one is asking myself at the very last, moment, if this stock continues down and I'm in the red, is this a stock I want to own? Is this a company I believe in with a product or a service that I have analyzed and I truly see it as a winner and, it fits? Is this a stock that I would not mind holding on to through a tough time? Okay. That's me. I don't invest in a lot of speculative stocks that, let's just say, unprofitable companies that are trading purely on momentum and on sentiment, but are years away from making money. There's a lot of stuff with outer space and with low orbit space, within our atmosphere that can fit that. For example, I believe in them long term, but right here and now, these companies are not, the numbers are not working for me. And if something like that were to fall, it could keep falling very easily. But if there is a stock that is solid, and I'm just going to use the example of Apple. Apple, I would feel fine putting in my 25% of my full allocation to that stock and seeing it fall down below my price. Price dips, I bought here on a dip and it dipped further. I'm okay holding that. I believe in the company. I believe in their numbers, their cash flow, their user base, so many things about the long-term prospects of the company. So it's different depending on what stock you go into. So anyhow, going back to the simple 2-to-1, two winners for every loser, two single tranches of winners. So we're talking about three different stocks. Hope that didn't confuse you, but when you have one stock, you put it in on a dip and it dips further, all you can do is hold on to it or get rid of it. And we'll talk about the get rid of part, later. The other stocks that you do the same with, they win. You want two winners for every loser. And at the end of the day, are you happy with what you own? Are you confident in that company? Confident enough to hold on to that tranche, that 25%? So, blah, blah, blah. It's a lot of talking. I am moving on. And anyhow, the other part of that is if you're an investor, okay, this is the one caveat. If you are not a trader, but a long-term investor, and let's go back to the Apple, for example, that your principle as an investor is you want to buy something and you want to buy it for the long term, 2 years or more, 5 years. Maybe you want to gift it to your kids or your grandkids, who knows? But you're going to hold this again for at least over 2 years, if not longer. Okay, then what you can do is implement a dollar cost average strategy and say, going back to the Apple example, I've analyzed it, I have my thesis, I've looked for a good catalyst. I'm expecting more catalyst coming up, like for Apple to fully implement artificial intelligence into their phone and software, and which they haven't done yet. So that can be a positive I'm looking for. But overall, I am an investor for several years. I believe in this stock. I've done my homework. Went up, it took a dip, and I bought at that dip, and then it fell a little bit further. Okay. As a long-term investor, you can take those 4 tranches of your full investment in Apple, and your first one, as we know, is in the red. If you are a long-term investor for years, forget about that. Wait for 1 month. 1 month to the day, you take your second tranche and you invest it. You can see where the price is for the day, but you must put it in on that day. The third tranche goes in on the third month, and the last fourth tranche goes in on the fourth tranche. So you've invested a quarter, a quarter, a quarter, a quarter over a 4 month period. That is the caveat to what I said earlier, which is more regarding to getting into the stock. If you're long term for years, you can do that. That's the investor strategy on that. And over those 4 months, you're going to go through more than one complete earnings cycle, and you are going to dollar cost average. Maybe your first, entry was here at a loss. Your second one, maybe it's even further down, at a loss, and you're like, well, wait, why am I doing that? But you've taken those 2 losses and averaged them out, to a little bit of a higher price. So the price has been going down your second tranche, but then it starts rising and rising even more, and you buy your third and your fourth month here. Your dollar cost over that amount of time, and then comparing to the long term, it gets you in the stock. And statistically, it's a solid way to enter a stock as a long-term investor. So there you go. And the last 2 things that I want to say, that expectations. I put down great expectations, no expectations, biases. So every morning when I come, before I open, when I wake up and I make my coffee and my delicious cappuccino, which maybe someday we'll talk about coffee because that's another passion of mine, is before I open my laptop or my phone, I reset my expectations, because I know where I am with my trades and my investments, and what, data may be coming out today, and, is CPI or PCE, which we'll talk about, coming out today. Is it going to be good? Is it going to be bad? And which is the measure, 2 different measures for inflation. But I sit down and I reset my expectations, because having a preset mind is a negative for me. All it does is it doesn't allow me to see with eyes wide open and to truly listen to the market every single day, because every day it changes completely. So all I can say is know what you're thinking about, and I don't want to say hope, because hope is not a strategy, as they say on Wall Street, but um, uh, whatever my biases are, I want to take an eraser and just erase that whiteboard and start fresh every day. It's a mindset, and but it's incredibly valuable. I have found it to be so. The other thing we talked about is just you've done all your homework, you've analyzed, you've built your thesis, you are looking for a catalyst, the stock looks good, the stock looks great, the stock looks amazing. Just wait until it absolutely slaps you in the face and you know, if you can hold on and wait for that moment, um, it's going to serve you, because I know you're going to do your homework really well and pick a great stock. And if you can be disciplined, the fourth part of what we talk about, then it is going to serve you so well. Analyze, thesis, catalyst, discipline. Fantastic. So anyhow, that's it for today. Thanks for watching Wall Street Weatherman, and I'll see you in the next video. Cheers.